Welcome everyone. Good afternoon, good morning, or good evening, whatever the case may be when you're watching the video today. Thank you for joining us for today's webinar titled Fantastic Year-End Strategies for Professionals with Equity Compensation and Business Owners. My name is Kirk Chan. I'm a Client Engagement Manager here at Sierra Pacific Financial Advisors in Pleasanton, and I will be your host today. So let me take care of some quick household items first. To start off, we want to make sure that the presentation is indeed interactive. So we absolutely encourage you to use the Q&A feature in the Zoom console there to log your questions at any time throughout the presentation. We will have time throughout the presentation to address some of the questions, and we should have some time at the end as well. Certainly, if we can't get to any questions, we will be able to get back to you directly. So with those household items taken care of, let me introduce our speaker today, Daniel Goodman. Daniel Goodman graduated from San Jose State University with honors with degrees in econ and business finance. He also holds an MBA from Santa Clara University here in the Bay Area with a concentration in behavioral finance and quantitative decision methods. He is both a certified financial planner and chartered life underwriter. He is the director of financial planning and a wealth manager here at Sierra Pacific Financial Advisors. He has over 20 years of experience in the financial planning industry, enjoys using his extensive financial planning and investment knowledge to help clients achieve their financial goals and dreams. Daniel is married and father of 3 daughters. They enjoy gardening and raising chickens. Daniel is also an avid home brewer. He was previously the owner of the Good Brewer in Livermore. So if you have a chance to speak with Daniel, ask him about his brewing techniques. With that brief introduction, Daniel, the floor is yours.
Thanks very much, Kirk. I appreciate that. Okay, so in the essence of full disclosure, I have not brewed a batch of beer in probably a couple of years or more. So I still enjoy it, still like it, but I haven't done it for a while. Anyway, welcome this morning, everybody. I appreciate you taking time out of your day to spend it with us. And yeah, we're going to talk a little bit about year-end tax strategies, mainly for professionals that have some stock options and what we can do for some of those small business owners. So let's get right into it. So first, our agenda for today is we're going to talk about AMT tax. I mean, it's one of those things we hear about, but it kind of makes people's heads hurt. So we're going to talk about that a little bit, kind of what is it and how it's calculated. Then we're going to talk about options and RSU exercises and some vesting tactics that we can use. And then we'll talk about bunching our deductible expenses. So, is there a way we can be strategic in how we go about our deductions during the course of the year to try to capture that itemized deduction if we always seem to be stuck with the standard one? And then for business owners, we're going to talk about some of the opportunities around defined benefit plans. So that's a qualified retirement plan. And then also how you can leverage that to increase savings and also, which also helps with tax deductions for the business. And then we'll talk about that qualified business income deduction, the section 199A. And then everybody gets some bonus content. We're going to talk about a qualified opportunity zone, kind of what is it? And for some folks, how that might fit into their particular tax saving strategies as well. So first of all, the alternative minimum tax. So what is this thing? So it is a parallel method to calculate tax in this country. So we all know the normal way we've been calculating taxes ever since we got a job. But there's this parallel system that also gets done. And the main difference is how it gets calculated and what are some of the deductions that we get with our standard income tax that we don't get with AMT. Now, AMT doesn't apply to everybody because it was designed to kind of capture what were considered back in the day higher income people and making sure everyone's paying their fair share. So the income threshold, which is also called the AMT exemption, if you were single or head of household, the exemption is at $81,300. So if you're below that, there's no AMT for you. If you're married filing joint, that number jumps up to 126,500. If you're below it, no MT for you. However, most of us living here in the Bay Area, we're married, we're all working, we're probably well over these limits. So how do we make sure we don't get stuck in an AMT situation? There are things, as I said, that are deductible under your normal tax calculation that are not for AMT. And a couple of those we've listed there. Deductions for accelerated depreciation or depletion. So think about anything that you bought for your business that you can accelerate quickly, like a building or a large piece of equipment. So if you're taking the modified accelerated cost reduction system, MAKERS, that's an accelerated cost depreciation. Depletion is the same idea, except now this is if, say, you own some land that has natural gas or oil that you're taking out of it, that would be considered depletion. Qualified exclusion for small business stock. So this doesn't probably apply to a lot of people, but for those that own C corporations and that were under a business value of $50 million or less when stock was issued, if you were to create a capital gain due to that qualified small business, that would be exempt under ordinary taxes, added back for AMT. The final one, the one I think we're most familiar with, are capital gains when you exercise your incentive stock options. So most of us know that when we exercise our stock option, there's no tax due at that time. Again, that's your regular income tax calculation. However, with AMT, that spread gets added back. And so I think sometimes what happens is that's what causes a lot of tax surprises come the next year when we've exercised quite a lot of our incentive stock options and now we've created an AMT situation. So you have this calculation, your ordinary income tax and your AMT tax. You pay the one that's greater. So if your ordinary income tax due is $80,000 and your AMT tax is $50,000, you're going to pay tax on the 80. If, however, the ordinary income tax is $80,000 and your AMT is $120, you're going to pay tax on the $120. If there is a silver lining to any of this, it is the AMT tax credit. So when you have to pay that AMT tax, you do get a credit, and that credit you can actually apply to future years when your ordinary income tax is greater than your AMT tax. So if you have AMT tax in 2023, but in 2024 you do not, you're able to use that tax credit to offset some of that ordinary income tax that you had to pay in 2024. Bottom line is we want to avoid AMT wherever we can. So here we want to talk about what is an effective strategy. Like, how do we figure out, excuse me, how do we figure out how much ISO I can exercise and not create an AMT situation? This is a lot easier to do at the end of the year because you've got a lot of view towards what your income is, what your earned income is right now with only a couple of months left in the year. So what you want to do is, and there's software out there that can do that, or you can work with your financial advisor and they will help you do this. And we're happy to help you. If you need the help, just give us a call. What you want to do is you want to figure out, okay, how much taxable income do I have? And then how much of the spread can I include in that and not trigger the AMT? So it's the spread that's the important part, not the fair market value of the stock. I mean, the fair market value is important because that's what calculates the spread. So the spread is the delta between the fair market value on date of exercise and your strike price. So for example, if you were to exercise your ISO today, and that stock has a fair market value today of $11, and your strike price is $1, the spread or the bargain element is $10. And that's what's important for this calculation. So if you look at the table there on the right, you can see there's the 2023 base case. So in this particular example, this couple has about $305,000 of taxable wages. They've got about $22,000 in other income. They have a capital gain of $11,000 and total income of $33,000. Now, some of you that are math whizzes are going to say, wait, that doesn't fit. It's because there's other calculations that go into that taxable income line. I know it's a little confusing, but that's how this goes. Okay, They have total deductions of $5,000. They donate to charity and some other things, so they're able to get a little bit of a deduction there. So their adjusted gross income is $328,000. They don't have enough deductions to take the itemized deductions, so they have the standard deduction of $27,700, which leaves us with a total taxable income of $300,300. For this particular couple, the tax due on that is just a little under $57,000. Their marginal tax rate is 24%. Their effective tax rate is 19%. The effective tax rate is essentially the average tax they pay over all of their income. Okay, so John and Jane now want to try to figure out, we've got some ISOs we want to exercise, but we don't want to pay AMT. So then we do the calculation and we figure out the maximum amount of spread is 26,150. So if they exercise ISOs that generate a spread in total of 26,150, there's no extra tax. Their taxable income stays the same, their total tax due stays the same, their tax rate stay the same. So they're able to exercise without any negative tax consequences. However, let's say they don't do this exercise and they're saying, oh, we're going to exercise about $75,000 worth of bargain element ISO. Now, when they do that, now they've got a taxable income. Oh, let me back up. So one of the things with AMT is there is no standard deduction. So if you walk through that line, you'll see there's a $75,000 incentive stock option. And then on the standard deduction, you'll see that rather than getting the 27.7, they only get 22. So that's the other thing that happens with the AMT calculation. So now they have taxable income of $306,000 and their total tax due is just over $67,000. So that's an extra $10,000 of income of tax that they've created by exercising over max of their ISO. So now their marginal tax rate goes from 24% to 28%, and their effective tax rate goes from 19 to 22. So again, this is an exercise where you really want to look at it and try to be sure that we're not creating tax where we don't really need to. And then in terms of like, what's the final value of this? So now we look at what that exercise actually looks like. So same data as before. So now a couple other pieces of information. So we have 5,000 shares that have been granted with a strike price of $2.50 and a fair market value of $75. If they just exercise the maximum amount, they're going to be able to exercise 361 shares for a total market value of just a little over $27,000. If they go over the amount, they can exercise up to about 1,034 shares, which gets them a total market value of about $78,000. That all sounds well and good until you factor in the tax component. Because they've paid extra tax, they actually only get able to keep less than 13% over if they did an exercise. So if they keep with the maximum amount, they're able to keep all $27,000, right? So they keep 100% of that value. If they go over max, now they're only going to get the after-tax value is $67,000 because now they had to pay $10,000 in tax. So there's a 13% difference in how much value is left by going over max. So again, we want to really make sure that we're not creating tax surprises and we're keeping maximum value when we're exercising our incentive stock options. So while we do see a fair amount of ISOs, we see more and more RSUs coming out, restricted stock units. We've got clients at Amazon and Google and Meta, and we see a lot of restricted stock units. Not a lot you can do from a tax perspective at the day of vesting because they are going to vest when they're going to vest. You can't change that. You can't move that. It's just going to happen. It hits your W-2 and there you go. But the one thing you can do, the one thing you do have control over is your withholding rate. So the default rate is 20%. So a lot of times people don't really think about what is the withholding rate on the restricted stock unit. And then at the next tax year, they've got a big tax bill as a result. So one of the things you can do first and foremost is increase your tax withholding on your RSUs up to your marginal tax bracket. Likely, if you have a significant 6-digit income, you're probably at least in the 32, if not the 35 or 37% tax bracket. So if you can increase your withholding on those RSU exercises, that will help to mitigate any tax surprises you get come tax time. The other thing you can do is gifting of highly appreciated stock. Now, you can do this to charities through a donor advised fund, or you can do it as a family wealth transfer in gifting appreciated stock to children. So to a donor advised fund, or if you just directly to a 501c3 organization, that's a completed gift, and that's immediate tax deduction that you can take on your tax return, again, as long as you're over the standard deduction limit. And we're going to talk about that here in a minute. Okay, gifts to children, though. This sometimes can get a little, there's a lot of different ways to do this, and they all have pluses and minuses. So the first thing is to set up now we're talking about minor children. So the first thing we can do is set up what's called a universal transfer to minors account, or a UTMA account. When you do a UTMA, this is an irrevocable gift. So that you're not going to get this back, but you are the custodian. So you're able to manage this money during the lifetime while the child is a minor. So up until the point where they turn 18 in California, it's 21 in some other states, you have control of that. So the child gets it at age 18. The other potential downside of a UTMA account is that it is reportable on the FAFSA for college aid calculations. So that can be something to always, be considering when you're thinking about this. The other thing you can do is you can set up a trust. Again, we want this to be a gift, so we want to be tax deductible. So again, this has to be an irrevocable gift, so that goes into an irrevocable trust. These things are more expensive to set up and administer relative to a custodial account, but they do give you much more parental control over the timing and the distribution of those assets. So that's still a plus. The other thing is these accounts, because the minor child is the beneficiary of the trust, that is also reportable on the FAFSA. So again, something to consider. Then the other thing we have is this whole 529 account. So one thing about 529s is that these are also reportable on the FAFSA. However, if your parents, the grandparents, are the owners of the 529 plan, then it is not reportable on the FAFSA. So the strategy here would be to have your parents, the grandparents, open up a 529 for the benefit of your child. You then gift your highly appreciated asset to that 529. So now it's out of your estate. You get the gift percentage, and there's no FAFSA hit. The trick is you don't want your grandparents to start, or your parents to start giving contributions to the tuition out of the 529 plan until the child reaches their junior and senior year. And that's because there's a 2-year look back on the FAFSA. So if we have financial aid, we want to keep it. We don't want to endanger that by giving away money from the 529 too early. The other thing we want to be aware of is the kiddie tax. So if you had given your child this appreciated stock in a custodial account, and the child is earning more than $2,300 in a particular year, then that's going to kick in what's called the kiddie tax, which now means any of their income is taxed at your tax rate. So the idea here is you want to give growth assets to your child, not assets that create dividend income, because that goes against a $2,300 limit. The other thing we can do is look for any tax losses in your current investable accounts, whether that be as a result of RSUs or other things. So we can use these losses that we have, tax loss harvesting, I'm sure we've all heard of that, to offset any capital gains you've managed to generate during the course of the year. So if you have recognized capital gains already, you can have some losses, create those losses to offset those gains. You can also use losses to offset up to $3,000 of ordinary income. And we highly, highly recommend that folks track their unused capital losses with the Schedule D worksheet. Now, this is not in the Schedule D itself. It is in the instruction booklet. for the Schedule D. That worksheet is in there, and that's how you can make sure that you keep track of your unused capital losses, because capital losses expire at death, so you can keep those for an extremely long period of time. The last thing I want to talk about here is bunching of expenses. So this is a technique that really came out of the 2017 Tax Cuts and Jobs Act. It nearly doubled the standard deduction, but took away a lot of the itemized deductions. So the strategy was try to bunch as much of these deductible expenses into 1 year as you possibly can to try to capture that itemized deduction. Of the number of deductions that are allowed, the charitable gifting contribution is the one easiestly managed and controlled. So in this example, we have John and Jane client. Over the next 5 years, they plan to give $7,000 to charity. They've got income tax of $5,000 a year, property tax about 10, home mortgage interest about 48. So their total taxable deductions over the course of the year is around 26.5 to a little over 27,000. Assuming there's no change in the standard deduction amount, they never break that threshold to itemize. So they're always taking the standard deduction. Over the 5 years, that value is about $138,500. So they decide instead in 2023, they're able to bunch all of those charitable deductions into 1 year, into 2023. So they bring forward all those deductions for a total of $35,000. All the rest of the data is the same. So now they have total deductions of $54,500 over the standard deduction. So their actual deduction in 2023 is the $54,500. Now, they still take the standard deduction the remaining 4 years, but because they were able to accelerate that charitable gifting, they were able to bunch that expense. The value of their deduction is now $165,300. That is almost a $27,000 improvement in total deductions that they're able to take and to reduce their income by. So I will stop there for a second. I know that was a lot of information right there to see if we have any questions from the participants.
Very good, Daniel. We do have a few questions here. Let me start with, what if I exercise some ISO and I already owe AMT? Is there something I can do?
Yeah, so you can potentially manage that. So if you've already exercised some ISOs and it looks like you're in an AMT situation, the first thing you can do is AMT is for a particular calendar year. So if that stock that you exercise is at a loss, and since we've kind of had a soft market last couple of months, potentially that is the case, you can actually sell those shares that you exercised. That eliminates the AMT. And now you have a capital loss that you can use to potentially offset income or capital gains you've recognized later. If, however, that they're at a gain and you exercised the ISOs in the first part of the year, January, February, March, you can actually sell those shares to cover the AMT in like April, and you capture long-term capital gain treatment. So you've actually held the stock for 12 months. So that's long-term capital gains. And so you get to sell that, capture the preferential tax rate, and pay your AMT that way. But let's say you exercised in the middle of the year. So, and they're at a gain. So now you don't want to sell because that'll be ordinary gains, etc. So now what you need to do really is look back at your investable assets, your taxable account, and see if you have some losses there that you can harvest, or if you have some small gains to help fund that AMT tax. Yeah, good question.
Okay, the next question is kind of a statement, but I think there's a question in there. A lot of employers don't allow higher withholding rates on stock vests. So I guess it's maybe company policy. They suggest paying estimated tax to cover the difference. You want to comment on that, Daniel?
Yeah, I would say, check with your HR and your stock plan administrator and see if you are able to increase your withholding to a higher rate. And if you're not, I think absolutely the best option then is to figure out your estimated tax paid at quarterly, and then do it that way. The biggest thing is you just want to really avoid a big tax surprise come April. So being proactive, whether that means adjusting your tax rate or your withholding rate if you're able, or paying quarterly estimated taxes, either one of those is a great way to, again, avoid a big tax bomb come April. It's a good point.
All right, there's just one question here left. Also, I want to encourage everyone to use the Q&A feature at the bottom there in the Zoom menu option to log your questions, and we'll get to them whenever we can. The question surrounds 529s. Can I contribute to 529 using the sell from RSU to avoid tax?
So you will not be able to avoid the tax on the W-2 at time of vest. That tax is just part and parcel of how a restricted stock unit works. If you sell the day of the vest, and this is actually not to get too far afield, but this is somehow we generally recommend our clients is really to treat RSUs as a cash bonus. But so if you do that, if you have a same day sell, then certainly you can take that money, fund the 529 plan, but you still have to pay income tax on the value of the RSU at the date of vest. If, however, you've held your stock as a result of the RSU, so say it vested this past March, you're still holding it today, likely you've got a capital gain in there. So what you do not want to do is you do not want to sell the RSU and then take the cash and put it in the 529 plan. That is tax inefficient. And that's something when we talk about gifting, we always try to get our clients to gift appreciated stock rather than selling it and then giving the cash, because you're paying capital gains tax. If you gift appreciated stock, which you can do to your 529 to answer your question, you want to gift the appreciated stock to the 529 plan directly, and you should be able to do that. 529s can hold just about anything, especially stock and mutual funds. But yes, you generally always want to be sure that you're gifting appreciated stock rather than cash.
Okay, we have one additional question that came up on this slide. Does SALT apply to this slide?
So the SALT deduction would only apply if you were able to include it in the standard deduction. So, or if you had enough other deductions plus SALT to get you over the hump. So, but yeah, also the other thing about SALT taxes, they are deductible, but you want to be aware of AMT, because the SALT deductions aren't part of the AMT calculation. So if you think you're going to be part or subject to AMT, you want to make sure that you don't pay any installments that are due in January and December. So you want to kind of be aware of what you're doing with, like, especially your property taxes, since those are the ones that people sometimes will pay forward. Well, I hope that answers the question.
Yes, very good, Daniel. I will let you continue now with the presentation.
Great. Thank you very much. Those are all great questions, everybody. Keep them coming. Thank you. Okay. Small business owners. So we all know about the 401k plan, the SEP IRA, and those things. But one of the things that is becoming very popular for small business owners in a way to juice their own retirement and also help reduce their tax burden is a defined benefit plan. So a defined benefit plan is a pension plan, and it's a qualified retirement plan. So there are costs associated with starting these things and managing them and all this and that. However, the government wants to encourage small business owners to actually start up these plans. So they have these startup credits, which is what you see in the slide here. So we do talk about, so there is some fee associated with these, and the slide starts at 5,000, goes down to 3. And then you have the employer contribution. So on this particular slide, this business has 20 employees, and the employer is contributing $1,000 for each employee. That's the $20,000. So the total cost of this employer in this case Starts at 25, goes to about 23 over the 5 years of the slide. So the business owner is able to get a fee credit for the first 3 years. So you can see that in the slide there. You've got 5,000, 3,000, 3,000. So you get a credit for those first 3 years. He also is able to get a contribution credit as well. So in the first years 1 and 2, it's 100% of contribution, so $20,000 in this case. In year 3, it goes down to 75%. So now it's a $15,000 credit. In year 4, it's 50%, 10,000. And in the final year, it goes to 25% or 5,000. So in this case, the incentive for this employer to, from a cost perspective, to start with a defined benefit plan, he's able to get $81,000 in credits to create this plan. And this doesn't even include the tax benefit of the tax deductibility of the contributions. So how are these contributions figured out? Again, it's a defined benefit plan versus a defined contribution plan. So a 401k plan or a 403b is a defined contribution. Our contribution is defined as 5% of our income, 7% of our income. A defined benefit plan, on the other hand, says I'm going to give X amount of dollars to this employee, that employee, that employee. It's a defined benefit. So how do we calculate how much we have to contribute to hit this benefit number? Well, that's where actuaries come in. And it's based on the participant's age and their contribution, their compensation, their life expectancy, and net profit of the company. So these things all kind of go into the actuarial calculation of how much the business owner must contribute to the defined benefit plan so that it's fully funded. Older participants, because they have less time to retirement, get larger contributions. So this is a net positive for those older business owners who are looking to retire in maybe 5, 6, or 7 years. So they get a larger percentage versus, say, a younger employee who's in their 20s, because they have a longer roadway to retirement. I haven't set up a defined benefit plan, so how can I take advantage of that? Well, you actually have till tax day of next year to set up a defined benefit plan for the 2023 tax year. So this is something that you're able to start engaging in now that you could potentially benefit your 2023 tax year. Whereas a 401k plan, that has to be done and in place and funded by December 31st. So again, a little bit more flexibility there. And then again, we already talked about the tax credits to offset plan startup costs. Now the savings part of this thing. So a lot of small business owners, especially self-employed, it's only one person. We do a SEP IRA because it's simple, it's easy, it's not a problem to set up. But with a SEP IRA plan, there's no employee deferral, so it's all on the employer, and contributions are limited to 25% of your earned income, and there's no catch-up contribution. So while a SEP is simple and easy, and it's cheaper than a 401k or cheaper than a defined benefit plan, it actually has a lot of restrictions around to it that make it not always the best ideally suited retirement option. So then the next option is a solo 401k plus profit sharing. So now this is a defined contribution plan where the employees are going to contribute some amount of cash from their paycheck, and the employer is going to include, in this case, 25% profit sharing. So if we look at the table, we've got the owner and his spouse. He's making $100,000. She's making $40,000. So with a SEP IRA, they contribute up to 25%, the limit. He gets 25, she gets 10. That's a total of $35,000 to their retirement, also what they're able to deduct. If they do the 401k with 25% profit sharing, so they still get the same amount, $25,000 and $10,000, but now they get $30,000 in employee deferrals to the 401k plan. So that is the total of, they're both over 50. So they get, for 2023, they get the $22,005 as the deferral, plus they get the $7,500 catch up. So that's how they get to 30. So when they do that, now they're able to save $95,000. So that's $60,000 more of retirement savings they're able to stash away while also reducing taxable income to the business. So now let's throw in the defined benefit plan. So we still have the 401k. We're going to reduce the profit sharing from 25 to 6%, but now we've got this big fat defined benefit plan that we're rolling on top of that. So you get all those benefits plus the additional retirement savings. And now in this particular case, after the actuary does their work, the spouse, the business owner is able to put away $250,000, the spouse $100,000. So now they're putting away $418,000. This is a significant amount over just a simple SEP IRA. So really good way that people can really juice their retirement and also help their tax situation from the business. So the other thing we want to talk about is what is called the qualified business income deduction, otherwise known as the 199A deduction. So this actually came out of the 2017 Tax Cuts and Jobs Act, which is set to sunset in 2025. This particular deduction is actually pretty popular. It has broad bipartisan support. So I would expect this would be something that even if the Tax Cuts and Jobs Act does sunset at the end of 2025, this is something that Congress would probably carry on into the future. And so what it is it provides owners of pass-through entities a deduction of up to 20% of their qualified business income on their taxes. So what is qualified business income? Kind of have a definition there on the slide, but broadly speaking, this is your net business profit. So there are some items that aren't included in QBI, and that is investment income like capital gains or dividends. These are not included in QBI. If you have business out of the state, say you've got a business in Mexico or Canada, income is from them is also excluded from QBI. And then any interest income not directly related to the trade or business is also excluded from the calculation. There are limits as to income of how much income you can have to qualify for the QBI. And this is based on the owner's total taxable income. So not just business income. So if you've got business income and then you've got some income from something else you're doing, all of that gets rolled in together. And so in 2023, for single filers, that limit is $182,100. And if you were married filing joint, that limit goes up to $364,000. And this is for businesses that are what are called specified service, trade, or businesses. So what is that? So this is a service-based business where the business depends on the reputation or the skills of the owner. So examples would include law firms, medical practices, consulting firms, accountants, financial services, investment managers. If you're a pro athlete, you're an SSTB. So good for you. If, however, you are over the income limits or you're a non-SSTB, you may still be able to take some portion of the deduction, but the calculation becomes much more difficult. And I'll be honest, it's kind of out of the scope of today's presentation. But again, if you're interested in this, you think you might qualify, give us a call or reach out to your own financial advisor or tax professional CPA, and they should be able to walk you through as well. The other cool thing about the QBI deduction is you can claim it on your 1040 even if you don't itemize. So that's a pretty nifty feature too. It's one of the few deductions that don't rely on that. So things to consider from a planning perspective is you want to drive your income below that QBI phase out limit. So try to control the timing of your billings. If you're accrual, see if you can do something with your accruals. If you're cash based, it's a lot easier. You just push recognition of any income into the following year. Any deductions that you can take that you can potentially accelerate, you might want to do that. Any new equipment purchases where you're able to take a full deduction rather than depreciate it over time. And again, charitable contributions. So again, I would also encourage you talking with your tax professional to make sure if you're doing these on the business side, since it's a pass-through organization, it doesn't do anything to potentially implicate or create an AMT situation that we've already talked about, since some of these things are preferential tax items for AMT purposes, meaning they get added back. And then kind of our last topic of conversation, that kind of that bonus content, is qualified opportunity funds. So a qualified opportunity fund is it's a private investment that looks to invest money in what are called qualified opportunity zones. So a qualified opportunity zone, it is a zone that is defined by the states. These are particular tracts of land or real estate that are in some need of repair, of little bit run down, needs a little extra life put into it. For those of you that were all Giants fans, you can think about the Giants Stadium when they rebuilt it on the water, how it really revitalized that whole area. Same thing with the Warriors stadium, also just south of the Giants Stadium. So those are like the idea of qualified opportunity zones. So the way this works is you get a tax deferral on capital gain. So that's the idea. So if you have a large capital gain, either through a significant ISO exercise or stock sale, a real estate sale that you did, like you sold an apartment building or something like that, or a business sale. You finally decide to exit the business you've had for years. You've got significant capital gains. What can you do with that? So a qualified opportunity fund is an opportunity for you to defer. Now, it doesn't get rid of the capital gains tax, but it defers the tax till 2027. So you're able to defer that tax, and then while you work out in other ways how you're going to fund that tax when it comes due. Now, the key here is that you have 180 days to invest that capital gain into a QLF. So there is a time frame that you have to work with. Once you put the money in there, there is a lockup period of 10 years. So understand that this is money you're going to have to understand. You're not going to need it for a significant period of time, that 10-year period. So in 2027, you defer your original capital gain. Now, after 2027, once the real estate has become settled and rents are being paid and all this and that, you start getting income generation from that. And then at the end of 10 years, you get a full step up in basis from where you started to the value in 10 years. So all that gain within 10 years is now tax-free to you, because you get a complete step up in basis. So it eliminates that long-term capital gain on the qualified opportunity fund asset appreciation. This is an investment that's not for everybody. So again, we would recommend that you talk to your financial advisor. If you don't have one, if you're interested in something like this, please give us a call. We're happy to walk you through how these things work. And before we get into the next little bit, again, a lot of information. I'll just pause real quick and see if anyone has any other questions.
Yes, Daniel, we do have some questions that came in. First one goes back to the what was covered previously. It says that wanted to check how much we can gift to our children when filing jointly. Also, if we pay our children on 1099 as compared to W-2 for some internship work in our company, should we rather do W-2?
That's actually a really good question. So I'm going to take the first part first, because that was the softball.
Okay.
So yeah, you can gift up to 2023. You can gift up to $17,000 per person per year. So if you're married, you get to double that to 34. This actually gets to the filing of what's called a gift tax return. I think there's some confusion over this, to be honest. So the lifetime exclusion is currently $12.92 million. So that's almost double that if you're married. So almost $26 million. Given current tax situations, again, this was part of the 2017 Tax Cuts and Job Act, which is set to sunset again in 2025. I think I've already said that like 4 or 5 times. So if Congress doesn't do anything this lifetime limit is probably going to go back down to kind of where it was prior to the act, which was somewhere like $3 million. It'll be adjusted for inflation, so it might be around 5. But to answer your question, what happens if you give, let's say you give little Johnny and little Sally $20,000. So you're over the $17,000 limit. You must file a gift tax return, which is informational only. You don't owe any tax. What happens is the government takes that $20,000 and applies it to the lifetime exemption. The only time you have to pay gift tax and actually write a check is when you go over the lifetime exemption. So I think there's a lot of confusion around that annual exclusion number. So you can give more. It just requires the filing of some extra paperwork, which I think is also why people tend to give up to the limit. So I think that answers the first question. 1099 versus W-2. Let's see. So I think that's actually a really good question. I'm going to say, I'm not really sure. I would say probably keeping them as a W-2, because if they're 1099, they still have to pay income tax, right? If they're W-2, they also still have to pay income tax. What you do as a 1099, what happens with the 1099 is you, the employer, the parent, you don't have to pay the FUTA or the FICA. So you basically put that on your kids to pay, because that still has to get paid. So I'll be honest, I would have to think about it a little bit more if there's a benefit one way or the other. But my initial answer, I'm going to say, I think I would probably stick with a W-2, just because I think it's easier from a tax reporting standard. Because again, you don't, the tax is the tax, whether it's 1099 or W-2, their income tax bracket is going to be the same, probably 0%, or if you pay them a lot, maybe it'll be the next bracket up, which I think is like 10 or 15. I hope that answers the question.
Very good, very good. We will let you continue, and absolutely encourage everyone to please continue logging questions using the Q&A feature at the bottom Zoom menu item there. Daniel?
Okay. So I just want to talk a little bit about our firm at Sierra Pacific Financial Advisors. So, we are a holistic planning firm. We don't just do investment management. We're also big into planning. As Kirk said, I'm actually a director of financial planning as well as a wealth manager here. So, I believe everyone deserves a plan. I'm a big proponent of financial planning at whatever stage of your life you're at, whether you're just getting started, you're in your peak incoming years, or you're getting ready to retire, or you're just entering retirement. I think planning is important. We do tax planning as part of our planning process. So we do like to talk about that, help people with that. You can tell we've done some stock options and execution strategies. So we have clients that work at Google and Apple and Meta, so we're very familiar with that. College funding, we're happy to help you with that. I have 3 daughters, one's already in college, so I have hands-on experience with this particular topic. Risk management and insurance. I'm a chartered life underwriter. I actually still have my my license, so I don't sell insurance anymore. I don't really do that, but I'm happy to talk to folks and help them figure out the best ways that they might be able to use insurance as a tool for wealth accumulation and wealth protection. We also do charitable and estate planning. And then for those small and medium-sized businesses, we also have corporate retirement solutions. So if you're interested in a defined benefit plan and other retirement options, not just DB plans, but other 401k or other qualified plans, we're more than happy to talk with you and help you try to put together a good plan. So we'll kind of get ready to bring this into a landing. Of course, we always have to end with a disclaimer. All good financial presentations need to do that. So here you go, everybody. All investments involve risk, including possible loss of principal. So this material is for educational purposes and is intended to be of general interest only and should not be construed as individual investment advice or a recommendation or solicitation to buy, sell, or hold any security or to adopt any investment strategy, and it does not constitute legal or tax advice. So with that, we'll answer any remaining questions everybody has. You guys have had a lot of good questions today. So really good questions today. I appreciate it.
Very good, Daniel. I don't see any other questions here. So we'll, in closing, we'll want to identify certainly that we appreciate the questions that you logged. If there were any questions we couldn't get to, we will be able to get back to you directly. Also want to note that we do webinars regularly here on a quarterly basis. So please be on the lookout for the next one when you receive the invitation. You can register for that. Also, if you would like to obtain any more particular information about today's topic, certainly encourage you to set up an initial consultation with us here at Sierra Pacific in Pleasanton. And also want to remind everyone that upon the conclusion of today's webinar, there will be a survey presented. So we absolutely would appreciate and encourage you to fill that out so that we can continue to provide information that is helpful to what your primary interests are. And with that, thank you again for attending and have a good day, evening, or whatever the case may be. Bye for now.
Thanks, everybody. Thanks for coming. Talk to you later. Take care.